Did you know that over 90% of people who invest in the stock market fail to beat the market over time? It sounds crazy, right? But it's true. Most investors either lose money or make poor returns because they don't have a strategy. That's where value investing comes in. In this guide, I'll show you how to invest smartly by finding undervalued stocks, companies that are selling for less than they're worth. Sounds simple, but there's a lot more to it than just buying low and selling high. I'll walk you through how to spot these opportunities, avoid mistakes, and build a portfolio that grows over time. Here's the kicker. People who stick to value investing and hold their investments for the long term have consistently outperformed the market. In fact, a study found that value stocks have beaten growth stocks by 4% annually for nearly a century. Imagine the power of small, steady gains over time. In the next chapters, you'll learn how to spot hidden gems in the market, why patience is the key to success, and how to avoid getting caught in common traps. Stick with me, and I'll help you make smart choices that set you up for long-term financial success. Ready to start? Let's dive in. Chapter 1. The Hidden Gems of the Market. Finding undervalued stocks. Investing for the long term doesn't just mean holding stocks, it's about finding diamonds in the rough. Undervalued stocks are the key to successful value investing. The trick is learning how to spot them before they catch the eye of everyone else. You don't need insider information to do this. It's all about understanding the numbers and the story behind them. So, how do you find these hidden gems? Start with a simple strategy. Look for stocks trading below their intrinsic value. In other words, try to buy a $100 bill for $50. Sounds good, right? To find these deals, focus on a few key financial metrics like the price to earnings (P/E) ratio, price to book (P/B) ratio, and debt to equity ratio. A low P/E ratio could mean a stock is undervalued compared to its earnings, while a low P/B ratio can signal the stock is selling for less than its actual book value. But remember, don't judge a stock solely on one number. Dig deeper into the company's future prospects and industry conditions. One of the biggest mistakes new investors make is buying based on short-term hype. Take Nokia, for example. It once seemed like a hidden gem in the early 2000s, but failing to adapt to the smartphone revolution led to its decline. Always remember to evaluate the company's growth potential. Another crucial tip is to look for companies with strong cash flow. Cash is king, and a business that generates consistent cash flow is usually well-positioned to survive tough times. You'll want to focus on companies with low levels of debt, as they can weather downturns without crumbling. But here's something that sets successful value investors apart: patience. Often, undervalued stocks take time to appreciate. Value investing is a marathon, not a sprint. As Warren Buffett says, the stock market is a device for transferring money from the impatient to the patient. Historical data shows that value investing has outperformed other strategies over the long haul. A study by Morningstar found that, on average, value stocks have outperformed growth stocks by 4% annually over the past 90 years. That's the power of finding hidden gems early on. To get started, use screening tools like Yahoo Finance or Morningstar to identify undervalued stocks. Look for companies with a low P/E ratio, strong earnings growth, and low debt. Don't be afraid to dig into the company's financials and listen to earnings calls. The more you know, the better equipped you'll be to spot opportunities. While many investors chase the hot stocks of the day, your goal should be to uncover companies with solid fundamentals that are simply being overlooked. Patience, research, and understanding the numbers will help you uncover those hidden gems that can become your portfolio's star performers. Chapter 2. The Power of Patience. Why slow and steady wins the investment race. In the fast-paced world of investing, patience isn't just a virtue, it's a strategy. Many new investors are drawn to quick profits, but value investing is all about the long game. If you want to see real growth, slow and steady wins every time. Warren Buffett once said, "Our favorite holding period is forever." While you don't have to hold forever, the idea is clear. Buying good businesses and letting them grow over time is the key to success. It might feel like you're missing out on quick gains, but history shows that patience pays off in the long run. The key to patience is understanding the power of compound interest. Albert Einstein called compound interest the eighth wonder of the world, and for good reason. It allows your money to grow exponentially over time, but only if you leave it invested. For instance, if you invested $1,000 in the S&P 500 in 1950, by 2020, it would have grown to over $400,000, assuming dividends were reinvested. That's the power of staying invested and letting time do the work. The stock market has always recovered from downturns, and often, it's during those dips that the best opportunities arise. Think about the 2008 financial crisis. While many investors panicked and sold, those who bought undervalued stocks saw huge returns. A decade later, companies like Apple and Amazon saw their stock prices soar. Patience doesn't just mean holding onto stocks for years. It means resisting the urge to check your portfolio every day. If you find yourself checking the stock price every hour, take a step back. Focus on the long-term performance of the companies in your portfolio, not short-term fluctuations. One of the easiest ways to practice patience is by adopting a systematic approach to investing. Set a strategy, make your purchases, and then let them work. Value investing isn't about reacting to market news. It's about sticking to your plan and allowing your investments to grow naturally over time. Statistically speaking, markets tend to reward long-term investors. A study by J.P. Morgan found that if you missed just the 10 best days in the market over a 20-year period, your returns would be reduced by half. This shows how critical it is to stay invested for the long run. For beginners, the best way to embrace patience is through index funds. By investing in broad market index funds, you avoid the stress of picking individual stocks and can let the market's overall growth benefit you. Plus, you can still benefit from compound growth over time. Chapter 3. From red flags to green lights. Spotting value traps. While it's important to find undervalued stocks, it's just as important to avoid value traps. These are stocks that appear cheap but are actually losing their value due to poor management, market changes, or other long-term issues. How do you spot these red flags? Start by looking at a company's debt. A company with high levels of debt may struggle to stay afloat during economic downturns. If a business is taking on more debt than it can handle, it's a sign that things might not be as solid as they seem. As Buffett once said, the most important thing to do if you find yourself in a hole is to stop digging. Next, evaluate the company's revenue and earnings. If a company's earnings are consistently shrinking or if its revenue growth is stagnating, it's a huge red flag. In contrast, value stocks should show consistent growth over time, even during tough periods. Be sure to examine the industry in which the company operates. A great company in a dying industry is still a poor investment. Take Kodak, for example. Once a leader in the photography industry, Kodak failed to adapt to digital technology and became a value trap for many investors. Another red flag to watch for is poor management. A company may look undervalued on paper, but if the leadership doesn't have a solid track record, it's risky. Look for leaders who have proven they can turn businesses around and have experience navigating tough times. Don't forget to assess the competition. If a company is in a highly competitive market with little to no differentiation, it could be in for trouble. Always ask yourself, does this company have a sustainable competitive advantage? Lastly, take a hard look at the company's long-term prospects. Are they investing in innovation? Are they adapting to trends and changes in consumer behavior? A company that doesn't innovate may quickly become irrelevant, no matter how cheap its stock is today. In short, don't buy a stock just because it looks cheap. Look beyond the surface and ask tough questions. Doing your due diligence will help you avoid falling into the trap of buying low, only to watch your investment continue to drop. If you're finding these tips helpful, don't forget to subscribe. More strategies are coming your way to help you avoid pitfalls and make smarter investment choices. Chapter 4. Beyond the numbers. The art of evaluating management teams. When it comes to value investing, numbers alone don't tell the whole story. A company's financials can look great on paper, but the real key to long-term success lies in the hands of the management team. They are the ones who make the decisions that will drive the company forward or cause it to falter. So, how do you evaluate management? Start by looking at their track record. Have they successfully navigated tough times before? A good leader doesn't just make smart decisions during a boom, they know how to manage through downturns. For example, during the 2008 financial crisis, companies like Apple and Berkshire Hathaway thrived, largely because of the strong leadership of Steve Jobs and Warren Buffett. Another important factor is management's transparency. Are they open and honest with shareholders? A company that communicates openly about its challenges, opportunities, and strategy is more likely to build trust and perform well over the long term. As Buffett famously said, "It takes 20 years to build a reputation and 5 minutes to ruin it." The incentives of the management team also matter. Do their interests align with yours as a shareholder? If the management is heavily invested in the company's stock, they're more likely to make decisions that benefit shareholders. Always check if the leadership owns a significant stake in the company. This shows they're invested in the company's long-term success. If you're enjoying these insights, make sure to subscribe and stay tuned for more. Chapter 5. Unlocking Market Cycles. How to buy low and avoid FOMO. Market cycles are one of the most important factors to understand when investing. These cycles, driven by shifts in the economy, investor sentiment, and market fundamentals, can help you determine when to buy low and sell high. But it's crucial to understand these cycles to avoid the biggest mistake many beginners make: buying high out of fear of missing out, FOMO. The first step in understanding market cycles is to recognize that markets go through periods of expansion and contraction. During bull markets, stock prices rise and optimism is high. In bear markets, prices fall and fear sets in. The trick is to buy when fear dominates and sell when greed takes over. Warren Buffett's advice here is simple: be fearful when others are greedy, and greedy when others are fearful. This is the essence of value investing, picking up stocks when they're undervalued during market downturns and holding onto them as they recover. Historically, markets have shown resilience, often bouncing back from downturns. According to a study by J.P. Morgan, over the past 50 years, the S&P 500 has experienced 10 market corrections of 10% or more. Yet, it has continued to deliver solid long-term returns, proving that downturns can offer some of the best opportunities to buy. Chapter 6. The Buffett Blueprint. How to think like a billionaire investor. Warren Buffett's success in value investing is legendary. If you're looking to succeed as a value investor, there's no better blueprint to follow than his. His principles, developed over decades, offer timeless wisdom for investors looking to build wealth over the long run. So, what can beginners learn from Buffett's approach? Buffett's first rule is simple: never lose money. While this may sound overly cautious, it reflects his focus on risk management. For Buffett, the priority is capital preservation. He seeks investments that offer a margin of safety, meaning stocks that are priced below their intrinsic value. This reduces the risk of loss and ensures a higher chance of long-term success. Another key principle from Buffett is to invest in businesses you understand. He calls this staying within your circle of competence. If you don't understand the business model or industry, you're taking on unnecessary risk. Thanks for reading. Don't forget to subscribe for more in-depth investing tips and strategies.